Hello everyone, this is Ronald Apart with the Mortgage Alliance Company of Canada. Choosing a mortgage that is right for you. A mortgage is a loan to help you buy a home or other property. Mortgages have different features to meet different needs. Make sure you understand your options and features lenders offer you when you shop for a mortgage. This will help you choose a mortgage that best suits your needs. The main difference between open and closed mortgages is the amount of flexibility you have in making extra payments or paying off your mortgage completely. Putting extra money towards your mortgage is called a prepayment. Prepayments allow you to pay down your mortgage faster. Open mortgages. The interest rate is usually higher than on a closed mortgage with a comparable term length. This is because it allows more flexibility if you think you made extra money towards your mortgage on top of your regular payments. Open term mortgages allow you to do the following at any time during your term without paying a penalty. Put extra money towards your mortgage on top of your regular payments at any time. Pay off your mortgage completely before the end of the term. Renegotiate your mortgage before the end of your term. Break your contract to change lenders before the end of your term. An open mortgage may be a good choice if you plan to pay off your mortgage soon, plan to move in the near future, think you may have extra money to put towards your mortgage from time to time, such as if you get a lump sum bonus. Closed mortgages. The interest rate on a closed mortgage is usually lower than on an open mortgage with a comparable term length. Closed term mortgages usually limit the amount of extra money you can put towards your mortgage each year on top of your regular payment without paying a penalty. Your mortgage contract includes a limit to the amount of extra money you may put towards your mortgage. You'll generally be required to pay a prepayment penalty if you make a prepayment that is more than what you lenders allow. You decide to break your mortgage contract. A closed mortgage may be a good choice if you plan to keep your home for the rest of your loan's term. A prepayment privilege provides enough flexibility for the prepayments you expect to make. Choose an amortization period. The amortization period is the length of time it takes to pay off your mortgage in full. The longer the amortization period, the lower your payments will be. Keep in mind that the longer you take to pay off your mortgage, the more you'll pay in interest. If your down payment is less than 20% of the purchase price of your home, the longest amortization you are allowed is 25 years. Choose a term. The mortgage term is the length of time your mortgage contract will be in effect. This includes everything your mortgage contract outlines, including the interest rate. At each term, you'll need to renew your mortgage. You'll most likely require multiple terms to repay your mortgage in full. If you're able to pay off your mortgage in full at the end of your term, you don't need to renew your mortgage. If you want to renegotiate your mortgage contract or pay off your mortgage before the end of the term, you'll have to pay a prepayment penalty. The amount you'll pay will depend on the type of mortgage you have and the terms and conditions of your mortgage contract. When choosing the length of your term, you may want to consider if you plan on moving, if you want to have the same prepayment for a longer period of time. Short-term mortgage. If you choose a short-term mortgage, you won't have to wait as long if you want to renegotiate your mortgage for a lower interest rate or change lenders without paying any fees. This may be a good choice if you expect interest rates to go down or if you may need to change your mortgage within the next couple of years. For example, if you think you'll be moving to a new home. However, if interest rates go up, you may need to renegotiate your mortgage at a higher interest rate. Long-term mortgage. If you choose a long-term mortgage, you can lock in an interest rate for a longer period of time. This may help you with budgeting since you'll know for certain what your housing costs will be for a longer period of time. However, you may not be able to make any changes to your mortgage contract for several years without having to pay a prepayment penalty. For terms longer than 5 years, you may pay a lower prepayment penalty after 5 years have passed. After 5 years, you'll only be charged 3 months interest on the remaining mortgage balance if you want to make changes to your mortgage contract. Convertible term. A convertible mortgage means that some short-term mortgages can be extended for a longer term. Once the mortgage is converted to extended, the interest rate will change to the rate the lender is offering for the longer term. Decide on a fixed or variable interest rate. Interest is the amount of money you'll pay to a lender for borrowing money. When you apply for a mortgage, your lender may offer different options to calculate the interest you'll pay on your loan. A fixed interest rate may be better for you if you want to keep your prepayments the same over the term of your mortgage. Know in advance how much your mortgage will be paid off by the end of your term. Keep your interest rates the same because you think there's a good chance the market interest rates will go up over the term in your mortgage. Variable interest rate mortgage. A variable interest rate mortgage can increase and decrease during the term. If you choose a variable interest rate, you may be offered a lower interest rate that one you get if you select a fixed interest rate. Keep in mind that the rise and fall in interest rates are difficult to predict. Fixed payments with variable interest rate. If the interest rate goes up, more of your payment will be applied to the interest rate and less to the principal. If the interest rate goes down, more of the prepayment will apply to the principal. You'll pay off your mortgage faster. With the adjustable payments, the amount of your payment will change if the interest rate changes. A set amount of each payment will apply to the principal. The interest portion will change as the interest rate changes. You'll know in advance how much of the principal will be paid at the end of the term. If the interest rate rises, your payments will increase. Make sure that you will be able to adjust your budget in case your payments increase. If the interest rate goes down, your payments will decrease. To protect yourself if interest rate rises, ask your lender if it offers an interest rate cap, a maximum interest rate your lender can charge on a mortgage. You'll never have to pay more of the interest rates in the maximum cap, even if the interest rate rises. A convertibility feature, where at any time during the term, you can convert or change your mortgage to a fixed interest rate. Note that if you choose a convertibility feature or change your mortgage to a fixed interest rate, you'll usually have to pay a fee. Certain conditions may apply. Your new fixed interest rate may be higher than the variable interest rate you've been paying. You could choose a hybrid or combination mortgage. In these mortgages, part of your mortgage has a fixed interest rate and the other part of your mortgage has a variable interest rate. The fixed portion gives you partial protection in case interest rate goes up. The variable portion provides partial benefits if rates fall. Each portion may have different terms. This means hybrid mortgages may be harder to transfer to another lender. When you make a mortgage payment, the money is split between interest and principal. Money is first put towards the interest and then towards the principal. The principal is the amount you borrow from the lender. When you first get a mortgage, most of your payments will go towards interest. The amount that you owe will only go down a little. As your mortgage balance decreases, more of your payment will go to the principal. Payment frequency. Payment frequency refers to how often you make your mortgage payments. Your payment frequency is set when you and your lender first arrange your mortgage, but you may be able to change it. Monthly, 1 payment per month for a total of 12 per year. Semi-monthly is twice a month, 2 payments per month for a total of 24 payments per year. Take your monthly payment and divide it by 2. Monthly payment divided by 2. The total amount you pay over the year is the same as the monthly payment option. Bi-weekly is every 2 weeks. 1 payment every 2 weeks for a total of 26 payments per year. Take your monthly payment, multiply it by 12, and then divide by 26. The total amount you pay over the year is the same as with the monthly payment option. Weekly, 1 payment per week for a total of 52 payments per year. Take your monthly payment, multiply it by 12, and then divide by 52. The total amount you pay over the year is the same as you pay the monthly payment option. Accelerated payment options. Accelerated weekly or bi-weekly payments will help you pay off your mortgage faster. Accelerated options allow you to make the equivalent of 1 extra monthly payment each year. This can save you thousands or even tens of thousands of dollars of interest charges over the life of your mortgage. Accelerated weekly, a payment of the half monthly payment every 2 weeks. Take your monthly payment and divide it by 2. With this payment frequency, you will make the equivalent of 1 extra monthly payment per year. Accelerated weekly, a payment of a quarter of the monthly payment every week. Take your monthly payment divided by 4. With this payment frequency, you will make the equivalent of 1 extra monthly payment per year. Mortgage security registration. A charge allows your lender to sell your property if you don't repay your mortgage as agreed. The lender will sell your property to recover the money you owe. Once you pay off your property, your mortgage charge is removed or discharged. There may be costs associated with discharging your mortgage. Ask your lender about the steps to discharge your property. The type of charge used by a lender varies. Different types of charges may be associated with different types of mortgage products. Before you make the final decision on your mortgage, ask your lender how your charge will be registered. A standard charge only secures the mortgage loan that is detailed in the document. It doesn't secure any other loans you may have with your lender, such as a line of credit. The charge is registered for the actual amount of the mortgage. If you want to borrow more money in the future, you may be able to use your home to secure the new loan. You'll need to apply and requalify for additional money and register a new charge. There may be costs such as legal, administration, discharge, and registration fees. If you want to switch your mortgage loan to a different lender at the end of your term, you may be able to do so by assigning your mortgage to a new lender. A collateral charge can be used to secure multiple loans with your lender, including a mortgage and line of credit. The charge can be registered for an amount that is higher than your actual mortgage loan. This allows you to potentially borrow additional funds on top of your original mortgage loan in the future without having to pay fees to discharge your mortgage and register a new one. Changing lenders when you have a collateral charge. A collateral charge may make it more difficult to switch lenders at the end of your term. Some lenders may not accept the transfer of your collateral charge mortgage. To change lenders, you'll need to discharge your mortgage. You'll need to repay or transfer to the new lender all loans you've secured with a collateral charge. This may include car loans or lines of credit. You may also have to pay fees such as legal administration, discharge, and registration fees. Check with your lender for details and if any discounts are available to you. If you plan on selling your home or moving, you may consider portable or assumable mortgages. Portable mortgage. If you're selling your home to buy another home, a portable mortgage allows you to transfer your existing mortgage to a new property and remain with the same lender. This includes the transfer of your mortgage balance, interest rate, and terms and conditions. You may want to consider porting your mortgage if you have favorable terms on your existing mortgage. You want to avoid prepayment penalties for breaking your mortgage contract early. Check with your lender to see if your mortgage is eligible for porting. Ask about any restrictions that might apply. Porting your mortgage to a home that costs less. If your new home will cost less than the amount you owe on your mortgage, you may be required to pay a prepayment penalty. Porting your mortgage to a home that costs more. If you need to borrow more money for your new home, ask your lender for details. If your lender agrees to lend you more money, your final interest rate may be blended into a combination of your old interest rate and the new interest rate. Your lender may charge you the current interest rate on the additional money you borrow. You may have to pay for additional amount on your mortgage loan insurance. Some lenders limit the time between the closing of the sale of the current home and the closing of the sale of your new one. For example, your lender may need to take repossession of your home no more than 120 days before and after you sell your current home. An assumable mortgage allows you to take over or assume someone else's mortgage in their property. It also allows someone else to take over your mortgage in your property. The terms of the original mortgage must stay the same. You may want to consider assumable mortgage if your buyer interest rates have gone up since the mortgage was first taken out. You're a seller and want to move to a less expensive home but want to avoid prepayment charges because you have several years left on the existing term. Most fixed rate mortgages can be assumed. Variable rate mortgages and home equity lines of credit can't. Approval of assumable mortgage. In most cases, the lender and the buyer who wants to assume the mortgage must approve the transfer. If approved, the buyer will take over the remaining mortgage payments to the lender and is responsible for the terms and conditions set out in the mortgage contract. Liabilities. After a mortgage has been assumed, the seller may remain personally liable for the mortgage. This means that if the buyer does not make their mortgage payments, the lender may ask the seller to make the payments. Some lenders may release the seller from being held responsible if the buyer is approved for the mortgage. Check with your lender to see if your mortgage is assumable. Lenders may charge you a fee to assume a mortgage. Your mortgage contract should indicate if you need to pay a fee to complete the transfer. A cashback mortgage is an option feature on some mortgages. It gives you part of your mortgage amount in cash right away. It can help you pay the things that you need when you get a new home, such as legal fees or furniture. Usually, if you use the cashback feature, your interest rate will be higher. The amount of interest you'll pay may end up costing you more money than you'll get as a cashback. Your lender can put limits on the cashback feature. For example, you may not be able to use cashback funds as part of your down payment. You may be asked to pay some or all of the cashback amounts if you decide to break, renegotiate, transfer, or renew your mortgage before the end of the term. Title insurance. Your lender may require you to get title insurance as part of the mortgage contract. The title on a home is a legal term used to define who owns the land. When you buy a home, the title of the house is transferred to you. Title insurance is an insurance policy that protects you as a property owner and your lenders against losses related to the property's title or ownership, such as survey issues, title fraud, problems with the title on the property, challenges of the ownership of the home. Survey issues could include an error revealed by a new survey where part of the home, such as the deck or garage, is actually on a neighbor's property. Title fraud occurs when a criminal steals your identity in order to fraudulently get a larger amount on the property or transfer your title to themselves and then sell your house. There are two types of title insurance. Lender title insurance protects the lender until the mortgage has been paid off. Homeowner title insurance protects you as a homeowner from losses as long as you own the home, even if there is no mortgage. How much title insurance costs? You may pay a one-time cost based on the value of your home. The one-time cost is called a premium. Premiums generally cost between $150 and $350, but it costs more. If you are the buyer, you are generally paid the homeowner title insurance premium when you purchase the property. If you don't buy title insurance right away, you can buy it at a later date. You can get title insurance from your lawyer or notary in Quebec and British Columbia, and title insurance companies, insurance agents, and mortgage brokers. If you have any questions, give me a call at 778-881-0276. I look forward to chatting with you. Take care. Bye.